Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Welcome to Markets Plus, where we cover the latest market, economic, and business trends. I'm Laurence Mutkin, head of EMEA Rates Strategy at BMO. Today, I'd like to introduce the first episode in our series of podcasts called BMO EMEA Perspectives. This one is our preview of the UK's first major fiscal event of 2025, Chancellor Reeves' Spring Statement, coming up on the 26th of this month. As we see it, whatever the specifics of the Spring Statement, 4 elements will determine the reaction of the gilt market and of the pound. 1, whether or not there will be a change in gross issuance in 2025-26 versus the plan as it stood at October's budget. 2, any impact on the outlook for Bank of England monetary policy via the impact on the outlook for growth and inflation. 3, evidence of changes to fiscal sustainability over the medium term. And 4, the shape of DMO's gilt issuance remit. We believe market participants should look at the Spring Statement announcements in this light. Just to say, we would like to keep these podcasts as interactive as possible, so please do submit your questions or comments by emailing me at laurence.mutkin@bmo.com. That's laurence.mutkin@bmo.com. Or you can find me on Bloomberg. Your feedback is valued. Please don't hesitate to reach out with any topics you'd like to hear about on future episodes. And now on to this episode. So our preview for the Spring Statement is that hopefully for markets, as fiscal events go, it will be quite uneventful. What are our expectations for the Spring Statement? Overall, we expect that although it's shaping up to be politically quite fiery, for markets, the Spring Statement should be relatively uneventful, and that would be a welcome change from recent UK fiscal events. It's also in keeping with the ambition that Chancellor Reeves expressed at her first budget of only having one true fiscal event per year, which she thinks improves predictability in the economy. We say it's going to be quite dull for 2 reasons. First, because Reeves doesn't really have that much scope for fiscal expansion or contraction, given the limitations imposed by her political constraints and by financial market realities. And second, the amount she needs to find to rebuild the headroom that she needs versus her self-designed fiscal rules, which is approximately, we think, 10 to 15 billion pounds, are very small relative to the size of government spending, which is about 1.3 trillion pounds. For the economy, we expect that the measures announced on welfare reform already will mean somewhat greater labour market slack as more non-working people are treated as unemployed rather than out of the labour force, which we think will bear down on the 3 measures of inflation persistence which the Bank of England's chief economist Hugh Hill introduced back in 2023, these being the vacancy to unemployment ratio, expected average earnings growth, and therefore eventually services inflation. In addition, we expect to see some measures at the Spring Statement to redistribute funds from the better off to some of Labour's favoured causes. After all, Labour MPs don't enter politics so they can cut benefits to the disadvantaged, and to fund investment in future growth. Even if that may drag on near-term GDP, Chancellor Reeves may well accept a period of adjustment, to use President Trump's phrase, in pursuit of her worthwhile long-term goals. In our view, the market would expect any redistributive measures to be at best neutral for growth, as market participants do not generally subscribe to the view that the state is better at creating wealth than the private sector. But these reallocations won't make much difference to the financial markets compared to the difference that would be made by the overall drop in spending. Hence, we expect the following results to come out of the Spring Statement. First, the fiscal rules will be met. Whatever combination of measures Reeves chooses, they will be enough to ensure that the Office of Budget Responsibility, the OBR, can make projections that show her self-designed fiscal rules will be met with some headroom in its forecast. We are confident of that because that is her primary objective in choosing which measures to adopt. Second, gilt issuance in fiscal 25-26 will be around $292 billion. We judge that it is unlikely that Reeves will increase borrowing significantly in 25-26 because, one, she recognizes the importance of gilt market confidence, and that's evidenced by her recent decision to initiate half-yearly meetings with gilt edge market makers, and that she understands the gilt market is very wary of increased issuance, and that increasing issuance can be self-defeating due to its effect on the government's debt interest costs. And two, as we mentioned, she doesn't really need that much money. Third, we think there will be a marginally lower trajectory for inflation and growth as a result of the spring statement. There should be little change to the economic outlook from the fiscal changes expected, and we see slightly more labour slack, potentially a mild drag on near-term GDP growth, and a slightly softer outlook for these inflation persistence indicators of few pills. So what does that mean our expectations are for the 2025-26 gilt issue remit for the Debt Management Office? Well, the shape of the remit is important to the market, the distribution of issuance between different parts of the yield curve and different parts of the marketplace. We reckon that the shape of the remit is likely to be in line with market expectations, i.e. there will be fewer longs, more mediums, and more issuance in the unallocated pot. We think that T-bill issuance will again provide a modest contribution to overall debt financing. We wouldn't be surprised to see a small increase in the retail targeted NS&I borrowing, but given past behavior, a meaningful increase would be a surprise. So what do we end up with? We end up with short issuance staying at 35% of total issuance, medium issuance rising slightly to 32.6% from 31%, long issuance falling to about 16% from about 20%, index-linked issuance unchanged, and unallocated issuance rising to 5% from 3%. We think the markets will like this, and as I say, we think this is more or less what the market expects because this is the distribution, broadly speaking, that came out of the consultations with the market makers and with the investors, which the DMO holds on a quarterly basis. So what does that mean we expect for the gilt market and the pound? Well, UK fiscal events have recently seen very large market reactions, with expectations for the terminal rate of the policy cycle, as expressed in the two-year forward rate, often swinging around by 50 basis points or more. We expect that, in contrast, this spring statement will be relatively uneventful for gilts and the pound, in keeping with Reeves's ambitions expressed at her first budget. Specifically, we expect short rates to price in 2 cuts this year, with a chance of 3, and an expected terminal rate between 3.75% and 4%. At present levels, the market prices just over 2 rate cuts this year at a terminal rate of around 4%. So this suggests little upside in the front end, but a bit more upside than downside to receiving two-year forwards. We do expect gilts to remain reasonably well bid on asset swap out to 10 years, but the gilt curve beyond 10 years to steepen versus the swap curve. Why do we say that? Well, certainly we acknowledge the challenges facing gilt asset swaps. The private sector surely faces yet another year of extremely high supply from both the Debt Management Office and the Bank of England as it unwinds QT. Also, global government bond issuance prospects are shooting up thanks to the necessity for rearmament in the European theatre. And thirdly, QT globally continues to reduce global liquidity. Nonetheless, gilts also have some very specific advantages. First, the Bank of England's unique decision to return to a shortage-based monetary framework means that, unlike others, the UK banking system will need to acquire over time many more gilts than it currently holds, in order to access liquidity at the central bank. It is notable that UK banks' gilt holdings do continue to grow, as does the use of the Bank of England's short-term repo facility, as we see the unwind of the COVID-era TFSME funding scheme. Second, the UK government's focus on fiscal targets, which we've just been talking about, looks relatively judicious compared to other major countries, almost as if the UK could become a fiscal safe haven. Third, the carry on 0 to 10-year gilt asset swaps is comfortably positive, albeit not generous. And fourth, the tail risk of regulatory change regarding banks is always for gilts to outperform rather than underperform swaps. On balance, then, we expect that gilt asset swaps to remain well supported out of 10 years despite this heavy level of funding. Next, the yield curve. Notwithstanding the small year-on-year increase in medium-dated gilt issuance, which we anticipate for 2025-26, we still expect the belly of 5-10-30 swaps to cheapen because, one, we believe the whole market has already anticipated this increase in mediums issuance, and two, 5-10-30s is just too low in the UK, both versus its own history and versus its international peers. Lastly, the pound. Well, the pound too should remain well supported by the combination that we expect of a broadly unchanged trajectory for bank rate and fiscal probity relative to many other countries. So what are the risks? The risks to the market that we see around our expectations are pretty balanced, we think. Specifically, we reckon A, the consequences of Reeves failing to meet her fiscal rules would be extremely bad for gilts and the pound, but the chance of that happening is very, very low. There's more chance, say 40 to 50%, of Chancellor Reeves raising the 25-26 CGNCR, that's the central government net cash requirement, from October's projected level, putting upward pressure on 2025-26 gross gilt issuance. But we also think that in those circumstances, there would be a decent chance, perhaps 30%, that T-bill and NS&I financing would rise versus last year too. So as long as the net effect doesn't lift 2025-26 gross gilt issuance above, say, 300 billion, we think the market will be okay, assuming that longer-term fiscal sustainability looks okay as well. Now, on the positive side, we also see a reasonable chance, say 20%, that NS&I and T-bill financing will rise anyway without an increase in CGNCR. And that would produce a fall in 25-26 gross gilt issuance versus our expected number of 292 billion. This would surely be very well received by the market, although it would still leave the private sector with over 300 billion to absorb when you include the Bank of England's active sales from its QT program, so we don't know how much upside there would be. Lastly, we assume the chance of Reeves producing a meaningfully austere budget are as low as the chances of her failing to meet her fiscal targets, so not very big at all. In sum then, we think the risks around these forecasts are fairly balanced. The market pricing probably already reflects the expected outcome. The big difference for us from where we're priced now is probably the two-year swaps can rally maybe 10 to 15 basis points. And we also believe that there's a good chance that 0 to 10-year gilts continue to outperform swaps over time.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.